Welcome to the weekly video update. This is being prepared over the weekend of April 23rd and 24th, where I'll talk about the action in the market over the past week and then see how things look for April 25th through the 29th. So let's go back over this week's session. It turned out to be quite exciting, especially Thursday and Friday. So for the week, there were a lot of concerns over rising interest rates. That's really what the market was focused on. All the different indexes really suffered this past week. And what goes hand in hand with interest rates is inflation. And then there's also some Fed policy. Some of the people on the Fed made some speeches over the past week that kind of spooked the markets, and they didn't like that. There was also news that somebody that's on the FOMC, a voting member, is going to retire, and the markets liked that person. Well, they don't like the fact that that person is retiring. And then on Friday, somebody came out and actually made some positive comments, and the market pretty much ignored that. So it was just decided that anything coming out of the Fed this past week was going to be negative. Up until Thursday, we were having kind of a ho-hum week. There wasn't a lot of economic reports that were released. There wasn't anything really geopolitical as far as Russia, Ukraine, or issues concerning the supply chain. Oil was kind of acting up, but it's been acting up for a while. Thursday was when everything really kicked into gear. On Wednesday, Netflix really got hammered big time. Well, then on Thursday, Tesla came out with their earnings report, and it was just taken as a ray of sunshine. The markets ended up really gapping higher on Thursday. Well, after trying to maintain higher prices, we went back and we filled the gap, and I'll show a chart of how this worked out. And we just kept going. And there was a 2.7% move intraday on Thursday. Well, we didn't really do a lot of damage at that point. Yeah, it was negative overall. But then Friday, we saw a 2.77 decline. So that's when the real decline took place over the past week. We ended up being down 2.8% for the week. So 2.7 and then 2.8. Volume was above average for the week. And we're still seeing, especially on Friday with the big down day, we're still seeing below average on a daily basis. But when you compare it all together on a weekly basis, we're still above average. The markets are really fixated on the technicals. They're really showing a lot of weakness right now, and I'll go through and explain that in the charts. Inflation and interest rates are a real concern. There are also geopolitical concerns that I mentioned. China, supply chain issues, that's still there, but not at the forefront. Oil, Fed speak, earnings. It just changes on a daily basis, and the market can shift quickly in what it focuses on. This coming week, I have a whole list of things, but it's not a lot different than this list. But something could shift. Something could take place geopolitically between Russia and Ukraine. That could change the whole situation. China might come out with something about their lockdowns that they're having. That could change everything. A company could come out with strong or weak earnings. That could change everything. As far as our trend, it's slightly strengthening, but it is negative on the weekly chart. So here's the intraday action. Way back over here, about in the middle of the chart. This was Monday. This is a new charting software package that I'm using with stockcharts.com, so it's going to look a little bit different. We just kind of bounced around on Monday. Tuesday, we saw this was kind of the strength move for the day. And then Wednesday, we pretty much were flat. This is when everything started to take off. We gapped way high. And then we came back, filled the gap, and just kept on going. All the way down, down, down. And then on Friday, we pretty much just picked up where Thursday left off. We just went down, 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 down. And on a technical basis, Friday was when all the damage was really done. And we closed just about at the low on Friday. So, and that's what everybody's talking about, and the financial media is going all crazy over these kinds of things. It's not very positive right now. This is how the index has performed over the last 5 trading days, over the last week. The small caps, they fared the best. And then we had mid caps down 1.5%. Dow was down 1.74. Then we had the NYSE and the S&P, that's what I focus on, was down 2.73% roughly. And then the Nasdaq and the Nasdaq 100, they led the way lower because we're really fighting this continuing battle between growth and value. And growth means tech companies. Growth means Nasdaq 100. Growth means these companies that you can get really good returns when you're right, but they go down quickly when things turn negative. And here's just a look. And my numbers will be slightly different here. The Dow was down 1.9% for the week, Nasdaq 3.8, the S&P 2.8, and the Russell, which is small caps, was down 3.2%. As far as our sectors, since we had a down week, I've sorted them according to the weakest at the top. And please don't mind this cursor right here. I take screenshots and that remains on the screen. Communication was down over almost 7.75%. Then we had energy, which has been doing very well, but it fell 4.57%. Then materials, tech was down 2.43%. There were only two sectors that ended up being up on the week. One is staples. Those are things that you have to have no matter what's happening in the economy. And then real estate was up 1.25% on the week. Then this just gives you a representation of how things performed. Real estate did the best, followed by staples. And then way over on the other side, communication did the worst, then energy, then materials, tech. Also, the nice little pink area there. As far as current market valuation, these are not necessarily up to date. When I'm recording this, they haven't updated the charts on their website yet. So if you're interested in this, you can either go there early in the week, currentmarketvaluation.com. There's the address right on this slide. Or I talk about this when the charts do update, probably in Tuesday or Wednesday's video. But it hasn't changed all that much, even with the big down day. I know everybody's focused on that, but in the scheme of things, we've had days like that before, and I'll just go through that when I get there. But our yield curve is still considered fairly valued. Now, we did have part of the yield curve go back inverted. We had two go back inverted. There was the 30 to the 5 year. That went inverted, but it's no longer inverted after Friday. And the 10 to the 5 year went inverted, and that's still inverted right now. Well, this model uses the 10 year to the 3 month. And that yield curve's been doing fine. It's been actually widening or going up during this whole time. So that's where they're getting their fairly valued from. And what I like about this is these charts, these are real charts behind it. They're not just to look nice. These are actual charts. So the Buffett indicator, which values stocks to GDP, it had been extreme coming off of that reading, but we're still overvalued. The PE ratio is still overvalued after getting pretty high. Interest rates, they're so very, very low. We're considering them, according to this model, to be fairly valued. Margin debt has not been updated since the end of February, but it's really dropping off. The mean reversion, this is probably what I pay attention to the most. It's how far away are we getting from the mean price. If we get too far away, it acts like a magnet and it'll bring price back to it. If it's above, it'll bring it down. If it's below, it will bring it up. So when you take all of this together, these folks say that we are fairly valued. I don't necessarily agree with that, mainly because I look at the yield curve differently, but this is still a good tool. It's a free tool, something that some of you might really find helpful. As far as sentiment, we did have the American Association of Individual Investors. They're giving readings. This is like the lowest number in a long time right here. These are individual investors. This comes out once a week. And then up above, you can just see the S&P. This is a chart that I have up here. And this just shows that individual investors are extremely negative. When they get this far extreme, we can often use that as a contrary indicator. And if you pause this, look at this chart, you can see when we got down really low, a lot of times that really marked a bottom in the market. Well, we're at that point right now. Then another thing that comes out once a week is the Rydex bearish. Those are mutual funds that go up when the market goes down versus bullish funds, those that go up when the market goes up. There's a ratio between the two. And this is not giving us an extreme reading right now. Back in the middle of March, we saw this real spike up. That just showed that people are freaking out. Well, it rose in the previous week and then came back down this week. So this isn't showing that mutual fund investors that like to trade both sides, both up and down trends, they're not really nervous right now. Then the VIX, we saw a real spike up, especially on Friday, where it's going up. We're well above 20 right now. On the bottom is the bar chart, which just shows as price has been going down, the VIX has been going up. But we can go a lot higher than where we're at right now before we get to some kind of an extreme reading. We could also turn from here and go down. Now, one thing I will say is you'll notice that there are really no labels on these charts. I had to make a decision when I went to record this. Do I want to put the video out there as soon as possible, or do I want to take probably an extra day to put the labels and what these different indicators are and then record the video? I decided for right now, I wanted to get the video out there. So look for more annotations on these charts starting next week. Then we also have a thing called the Ulcer Index. When this is going up, that means fear is going up, which also means the market is going down. It's actually been declining on the weekly chart. It's been rising on the daily chart. So weekly, we're not seeing an awful lot of fear in the bigger picture. Then this also shows us how the economy is doing. It's called the Chicago Fed National Financial Conditions Index. You got to love these names they come up with. But basically, if you look back here, this is 2008. When this thing really spiked up, that was the financial crisis. We didn't see too much in the year 2000 with the dot-com bust. But other times, especially going back into the 70s, this thing was all crazy. Well, look at where we're at right now. Yeah, we're climbing a bit, but we're not above this black line. If we're below this black line, the people that are behind the instruments that make up this index, they think they're not really worried about the economy. When we start to get up above that, that's when they are concerned. And these tend to be very knowledgeable folks. Now, this could change quickly. You can see back in the financial crisis, we spiked up and boom. And I look at this every time it's updated and keep a real close eye on this, but it's really not giving us any big reading right now. Then we have another indicator here. This is the credit spread, where you have the high yield option adjusted spread. This is just showing when this really spikes up, that means we're running into difficult times. Here's the COVID plunge. Here's the financial crisis. Here's the dot-com boom and bust. And then 9/11 happened right after that. Well, we're just kind of moseying along right now. So we're not seeing any real fear. And again, the folks behind these things tend to be very knowledgeable about what's going on. Another one is the National Association of Active Asset Managers. These are mutual funds that are actively managed, where they're going out looking for investments. They may buy some stock, and then when that tops out or they feel it's risky, they get out of that and they move it around. That's opposed to index investing or passive investing. And active investing tends to do better when we're going down because you can shift your money around. Where if you're in a passive mutual fund or even an ETF like the SPY, you just kind of ride it out because whatever the stocks are in the index, those are the stocks that you own. Well, when this is decreasing, that means that these managers are getting out of riskier assets. That means stocks. And when this is going up, they're exposing themselves to more risk, which means more potential reward. Well, right down here, this was where we bottomed in the middle of March. And that coincided with a really good bounce that came up out of that. Then we came up, Then we started to fall back. They fell back. Over the past week, they started to increase their exposure again, but not necessarily at an extreme point right now. This might fall a little bit next week because of the big decline. Another area that we need to keep an eye on is we're getting closer to the Fed meeting, and that's going to happen on May 4th. And as of Friday, there's a 99.6% chance that after the Fed meeting, we're at 25 to 50 right now, 0.25% to 0.5%. There's almost a complete certainty that after the meeting on May 4th, we're going to be at 0.75% to 1%. That means a 50 basis point move. And that's kind of what's freaking out the markets. There was some hope this past week that people in the Fed and Chairman Powell, that as they were speaking, they might suggest that maybe inflation is peaking. Well, they didn't really say that. And they're pretty firm on this 0.5% increase. And there may be even more in the future. Well, the markets don't really like that. That's what's causing either indecisiveness or downright declines. And then this gives you a historical view. And if you see this pink line on the chart, this is kind of interesting. At the very beginning of March, nobody was really considering the 75 to 100 level for interest rates, 0.75% to 1% for the Fed funds rate. Well, as we went through March and so far into April, that's becoming the dominant view currently. This is just the most updated version I could get of the Fed balance sheet. This is increasing. That means they're still in there doing their quantitative easing. And there's talk that in May, they may stop doing this. So we'll keep an eye on this chart to see if that's happening. What you would normally see is like what we saw in 2018 into 2019 is when they start selling or getting rid of all these bonds that they've been buying, you'll see this line start to go down. Well, it's still going up currently. So as I keep saying, it's like the Fed, they're looking at raising interest rates. That's putting their foot on the brake, but they're expanding their balance sheet, and that's like they're jamming on the gas pedal both at the same time. And that's really contradictory right now. As far as our breadth and different things to look at, you can see up here, based on price, this is kind of an extreme reading. That's why I have the red line down here. And sometimes when we've got to this point, this has marked some kind of a bottom. Doesn't necessarily mean that's what will happen this time, but to see that, we're not seeing this on the daily chart. I noticed this on the weekly chart. Based on volume, we're not really extreme right now. But when you look at the trend overall, we're still above the moving average based on price, and we're right on the moving average to slightly below based on volume. So this is inside of the S&P 500. Then we have another thing called the advanced decline ratio, and it's declining and below this line that we have right here, which signals that it's a little more negative right now. This is a 19 and 39 exponential moving average of the advanced decline ratio. And so it gives us a little longer term trend of how things are moving. Then the new highs, new lows, we can see down here, we set a whole lot of new lows this past week. And then when you take a 10-period differential between the two, we're pretty much flat on the week right now. And then here's accumulation and distribution. It shows weakness. Accumulation is when they're buying. Distribution is when they're selling. There's a 20-period moving average plotted here, and we've dropped below that. As far as our trend, this is the ADX, and this is where we're getting our negative trend from. We're turning up slightly with the ADX. The red line is on top and advancing. The green line is below it and declining. The red means selling. So this points more to a negative trend right now. And we are above 20. We're currently in a trendless, close to trendless environment on the daily charts. We're just starting to turn up, but we're well under 20 currently. Then here's the Arun. The red line denotes selling, and when that's pegged all the way to the top, that means sellers are in control. When the green line is pegged near the top, that means buyers are in control. Well, we pegged up recently with selling, but it actually dropped off over this past week. The thing that's keeping this negative is we're seeing a decline in buying as well. When you compare these two lines, this creates an oscillator. When we're below zero, that's negative, but we've been flat now for the last few weeks. Then here's the mass index. We're waiting to see if this will drop below this red dotted line, and that is a signal that this indicator generates. And we don't really know if that's going to happen. We just kind of have to wait and see. Long term, here are the pivot points. We've dropped below the pivot. Last week, we were right on the pivot. Well, we fell below that overall. And then you can see down here at the bottom where volume was just slightly above average. The volume from the previous week is lower because there was only 4 trading days in observance of Good Friday. And then looking at the trend, we are below this 50-period moving average right now. So that's negative, longer term. And then here's 2 moving averages where we had a recent death cross and we're below both moving averages, and you can see the down bar for the week. And here's BPI. This is Bullish Percent Index. Measurements. These are point and figure buy and sell signals inside the S&P. After getting a real extreme positive reading during that nice run up in March, we've been falling back. However, even though we're declining, we're still above this 50 level, and that's the line between positive and negative. Of course, we don't like to see this trending down if you're bullish, but right now, yes, it's declining, but still positive. And here's a thing called the Chaikin Oscillator. And we're starting to get to the point below this kind of pinky line here where we're getting an extreme negative reading. And if you compare these extreme readings with what happened in the market, a lot of times that denoted a bottom. Just like there have been times when this will denote a top when we're extreme positive. This could still go lower from where we're at right now, but we just want to watch this because it's in extreme negative territory. Then here's a thing called the Chaikin money flow, which has been pretty much declining since about November up to the current time. And then the force index, it is also negative, dropping below zero and turning red. Here's the McClellan Oscillator. After giving us an extreme positive reading, seemed like a long time ago now, it's really dropping down. It's below zero and declining and not necessarily extreme at this point. Here is the Summation Index, which goes hand in hand with that. We're seeing a decline based on price and a decline based on volume. But both of these are still above zero, so that's somewhat positive. All of our oscillators are pretty much looking negative. If you listen to many of my weekly videos, I don't pay as much attention to oscillators on weekly charts. I use them a lot heavier on daily charts. That's my own personal conclusion that I've reached. You may disagree with that. If you want to talk about it, please let me know. You can leave a comment. You can email me. And I just think that the way these things are calculated, I mean, look at the run up that we had right here, and we're seeing a negative divergence pretty much across the board. That's because these, as we're going up, higher values are being used in the calculation, so this thing can't help but roll over. So that's where I come out, but you may not agree with that. Then I don't really look at the PMO on top. What I look at is the indicator based on price, which is declining but still above zero, and volume, which is also declined but still above the midpoint. And here's another study showing that those PMOs that are actually rising, we're getting into extreme negative territory. We still could go further, but we want to keep an eye on this one. Those PMOs that are generating buy signals also declined, and those PMOs that are even positive, that also declined. So that's pretty negative. As far as the RSI, we are declining and below 50 right now. And then this is actually a little more positive. This is called Special K. It's a longer term measure for longer term trends. And even though this is declining slightly, it's still above this longer term moving average. Then we have the thing called the Swinland Trading Oscillator, where it actually turned up over the last week. That's kind of interesting. It's still negative because it's below these lines right here, but it actually advanced. And then this is the Williams percent R, where we had been coming up out of an extreme negative reading. Well, we kind of turned and now went back down and still could fall further. We also have a thing called the Stoke Rsi, where it is also declining after having given us an extreme negative reading. Then the Vortex saw a decrease in selling overall, and that includes Friday's session too, but it's also seeing a decrease in buying. The red line's on top, so that means this is negative overall. We have a thing called the Ultimate Oscillator. It's dropped below 50. That's negative and not giving us an extreme reading right now. Money Flow Index, it actually advanced was to slightly flat. If we can get above 50, that's a little more positive, but it's really not. It's going to take a lot of work to do that. Then we also have a percent B. This is how far outside of a Bollinger Band are we? If we're really moving fast and furious, these readings can become quite extreme. Well, we're declining because we're going down, and we're not necessarily getting an extreme reading right now with this. Our different charts, this is the Heiken Ashi, where we're seeing a dark candle. That's negative for the week. Here at the Kegi, this is still positive. As long as it's black, that's positive. If it turns red, that's more negative. So it's still hanging in there. We also have a thing called Renko. Now, this is where red is negative. These solid red bricks right here, that just shows that it's picking up a downtrend. And then we have the equivolume, which shows a big red candle for the week. Here's point and figure, and there was no new signal generated. The last signal was on April 11th. This is a weekly chart where it's showing a high pole warning. The pole is this X right here in the middle. Well, after setting that X with the nice run up that we had into the end of March, we're seeing more declines, and there were actually 2 new zeros added over the past week. The signal is old, but these red circles are new on the chart. So that would be negative overall. Then the 3-line break, we have a dark candle currently, so that is negative. Our different trading systems, the Elder Impulse system, we came right down to the 65 period exponential moving average, but it's red, and that's a negative. Down below, we're seeing a 65 period MACD. It's right on the line right here between positive and negative. This is called the stop and reversal. When the dots are below, that's positive. When the dots are above, that's negative. They're still giving a positive signal on the weekly chart. Looking at stocks, and again, I'm going to try to make these charts look a little prettier. Up on top is the S&P. This shows the past week's movement. The mid caps, which have pretty much been going sideways, and the small caps, which have also been going sideways for quite a while. Here's the all stocks, U.S. stocks as well as international stocks. It really declined after having a recent death cross. Then we have the mid caps, death cross, and we're dropping below the moving averages, but we're still kind of moving sideways, but it's still negative overall. Small caps, kind of the same thing, going sideways, but a recent death cross, and we're below the moving averages. Then the Dow, also a recent death cross, below the moving averages. I sound like a broken record here. That's why I look at a lot of different indexes, and if they're telling us the same thing, it's like confirmation. Now here, this is Dow theory. The very top, this is the Dow Jones Industrial Average weekly chart, where we can see the decline. The middle is the transports, where they just got hammered week before last. Well, they actually bounced up a little bit for a while, but then kind of came back down. And then utilities have really been performing quite well. They've been the dominant sector. Now, some people don't include utilities in Dow theory. I do. So you might vary if you're a Dow theorist. Then looking at the Nasdaq, this is showing a little bit more weakness. We're well below the moving averages after a death cross, and we're dropping currently. Nasdaq 100, kind of the same thing. Recent death cross really dropped, but we still have been lower than this before. NYSE, it was really trying to hang in there on the daily charts. And then right at the end of the week, Friday, it really started to show some weakness. But we are seeing a recent death cross and a real decline. And then here's the Wilshire, also another broad-based index. Pretty much the same thing. And then the FANG stocks, they were down 8.76% for the week. These are the big tech companies. And then here's ARC. Some of you are familiar with ARC Innovation. It was down over 11% in the week. My goodness. If you watch Cathie Wood YouTube videos, and she's like the rock star of ETFs these days, when she was going up, everyone thought she was great. Now that she's having some trouble with some of her strategies, people are just really slamming her. I don't see why. I mean, she believes in what she's doing, and you can't always go up with everything that you do. But that's just where I come out. These are the big software companies where we're kind of going sideways overall, but we're below a declining moving average. And then this is one thing to be aware of, and this is just on the table right now. It's kind of in the back part of the table. If you look at this chart, and if you've been watching my daily videos, you've been hearing me talk about this, but I just want to make you aware that when we take a ratio of staples to the S&P, we can plot that. That's what's down here. On the top is the S&P. When this ratio starts to really spike, and I didn't draw all the spikes in here that I could have. I saw a few and I just drew those. But a lot of times when this spikes up and then turns down, that denotes a pretty significant bottom in the S&P. We saw that back in the middle of March. Well, we're spiking up right now, but we don't really know if this is the top yet. We don't know if this is going to keep going. So this is a bit of a lagging indicator. We watch it, we notice it, and that's why I have a moving average on here. And if we combine it with some other things, this can give us a pretty good signal. Some of the other markets, here we have the Crb Index. It was down almost 2.5%, but it's still in an overall uptrend. This is one of the things that I use to measure inflation, because these are the commodities, the things that companies have to buy to make the things that we go to the store and buy. And if their prices are going up, that means our prices are going up too. Gold, it was down over 2% for the week, but it's still in a longer term uptrend, but it's just acting really sporadic on the daily charts. Same thing with silver. It's just kind of all over the place right now. And then here's oil, settled at 102.07. So yeah, it got up a lot higher, but it actually declined 4.5% on the week. Here's the dollar, which has just been really going up strong. We're up over 101 now, and that's mostly compared to the euro. Then some of our relative studies, this just measures if you had gotten into bonds based on price, how would you have performed compared to stocks? Well, not too good over the last few years. Turned up a little bit, but bonds have really underperformed. Now, at some point, we might hit a low. There might be some positive news that comes out that maybe inflation is under control. Interest rates might start going back down. That means bond prices will go back up. That could also produce a real rally in stocks, and bond prices could also end up going up as well. But that's just something that we're thinking about now. I'm not predicting anything like that, but we want to always be ready if we see that scenario start to develop. And this is a monthly chart of how would you have done getting into stocks or getting into bonds. This is kind of an inverse, although this is a longer term chart. This just shows how stocks have really outperformed bonds over the last few years. Then this is a daily chart going back to the beginning of the year. This is intermarket analysis. So I'd start this from December 31st all the way up until the present time. Oil, even though it's been down, has still performed the best. Gold has been doing okay, but trailing off. Here's the dollar. It's really been holding up pretty good. Here's the S&P, which has been declining. And this is TLT. This is bond prices right here. They've had just a really difficult year this year so far. And then here's the gold to the dollar. Gold's been going up, but kind of sporadic. The dollar's been really strong. So we're not if gold was outperforming the dollar, we would see this going up, and that's just not happening right now. And then here's gold against the S&P. Gold has been doing better than stocks, both on the daily charts and here on the weekly charts. And then here's low volatile stocks. These are more the value stocks, the stocks that don't go down as much. And you can see that this ratio was up almost 2%. They outperformed the S&P over the last week. And this is more the value growth battle that we've been seeing. Then here's growth against value. This is the battle. This just shows how growth has been declining. And here we have the Nasdaq 100, which has really been underperforming the S&P itself. Here's the S&P 100 against the rest of the S&P 500. It's been underperforming, and those are the bigger, well-known names that make up the S&P 100. Here's discretionary, the things that you'd like to have in a ratio against staples, the things that you have to have. And it just shows that these are going down because people can't splurge right now, where the economy is really struggling, and inflation and all the different news that you hear going on. So buying that boat or getting that RV, people are just deciding to wait, and that's affecting the stock prices of discretionary stocks. But people still have to get staples. You still need toothpaste and toilet paper and things like that. Okay, and then here's just a measure between energy and tech. And it just shows how energy has really outperformed tech, especially since the beginning of the year. So what's our outlook then, based on how things look? And really, you can't go too far out with this as far as coming up with what's going to happen for the whole week. There are so many variables that we need to consider. But the technicals are negative. And on the daily charts, we have a short term and even a bit of an intermediate term oversold condition right now. That could produce some kind of a bounce. But if we do bounce, can it get some legs? Or are we going to continue to go down and become even more oversold than we already are? The markets are pretty much in a trendless intermediate term range. Now, if you are looking at the daily charts and you see the ADX starting to go up, you might think that a trend has already started and that trend is down. If you're more conservative with that ADX, you want to wait until it gets above 20. Then the battle that I'd keep talking about keeps going on between growth and value. We have supply chain issues. There's no economic reports coming out on Monday. I have another slide where I'll talk about the important ones for the week. And then we have all these different geopolitical events down here. And any one of these could come to the forefront at any time, either positive or negative. Then this is more what to look out for. On Tuesday, as far as economic reports, we have durable goods, consumer confidence, and new home sales. Those can be pretty influential when they're released. On Thursday, we have the advanced GDP report coming out. That's the measurement of the entire economy. Then on Friday, we have personal income and spending, PCE prices, employment cost index, the Chicago Purchasing Managers Index, and then the final reading of consumer sentiment. So a lot of these things I'll be going over in next week's video. And then down here, this kind of is a repeat of the previous slide. These are just things to keep in mind. And if you pay attention to the news, you pay attention to things, these are the different areas that you just want to be focused on right now. And there may be something that comes flying in that isn't even on this chart, either positive or negative. So then what I've done here is I've come up with scenarios with as they stand right now. And I really have two scenarios. If you're more conservative in how you use the ADX indicator, to determine whether we're trending or not trending, then you're probably going to lean towards scenario 3. The ADX on the daily chart is below 20 but starting to climb and showing a negative trend. When we're in more of a sideways movement situation, price movement can really slow down. It's like, try to explain to somebody about how Friday was a slow down and choppy day. But overall, looking at the charts, we have been pretty choppy when you look at the bar charts of each day and each week. Now, if you are a little more aggressive with the ADX, and once those lines cross on the daily chart, you say, aha, we are now in a trend, and the ADX is telling me that's a negative trend, then you might go with scenario 1. What can keep the market going down from here? Well, if interest rates continue to go up, if there's still a lot of inflation fears, if there are bad earnings reports, if the Fed people come out and start saying things that freaks the markets out, and then we already have a negative technical picture. So those things could keep things going down. What in the world could help things go up from here? Scenario 2, which is not where we're at right now, but we are at a short-term and somewhat intermediate-term oversold condition on the daily charts. So that could produce a bounce. And then this really isn't on the table. This is the chart I was showing you. No, actually, I didn't show you this. But on the yield curves, when all the yield curves, when all of them go back to being normal after having been inverted, sometimes we see a really powerful move in stocks after that. That hasn't happened yet because we still have one of our yield curves that's inverted. And then the staple spike, that's the one that I did show the chart of. That potentially could be positive in the future, but we don't know if this chart has spiked, if it's hit its top yet. Then as far as the technicals, there are moving average and pivot points either in the S&P or in other indexes that may provide support if we continue to fall, or resistance. And then there's other support and resistance levels that we may also hit, previous lows and so forth. So what's our conclusion based on how things looked after Friday? The S&P, and this is mostly focusing on the daily aspect. The S&P is negative. Short term, it's negative but oversold. Intermediate term, it's negative and partly oversold because our oscillators are negative and we're below some very important moving averages. Longer term, on the daily chart, we are negative because we continue to be below the 200-day simple moving average. So thank you very much. I hope you found this helpful. Again, I'm going to add some more of these labels and annotations next week. I hope you do have a wonderful week, and I will prepare the weekly video next weekend.